This is part 2. The books. Keep them and close them. Just don't cook them. As I mentioned in a previous video, the system of accounting that we use today has its foundations in Florence and Italy in the early 13 and 1400s. Jacob Soll, in his book The Reckoning, says that the medieval Italian merchants invented what is called double entry bookkeeping. And in his comments on Ditini, he said that Ditini's records reveal how complicated business was during that time period, and how keeping double entry books required immense skill. Pacioli, as we talked about before, the father of accounting, who again didn't invent this stuff, but documented for the first time the system of accounting that the Italian merchants were using. Documented the system of double entry accounting in his Summa de Arithmetica. Now, why all this talk of books? And what the heck is double entry bookkeeping? Books, originally, were what was used to keep track of all the financial information related to a business. Back in the 13 and 1400s, obviously they didn't have computers, they didn't have software programs, and so everything was done with pencil and paper. So the financial records of a business were generally referred to as the books, because they were actually books. That's where we kept all the financial records, all the transactions, all the details were in books. So, if you're going to keep a set of books, you're the financial person who does that, then your title is bookkeeper. And that's kind of where the title that we still use today comes from. But today we don't really use books anymore, not physical ones anyway. We use software programs. And these software programs even sometimes have the word books in them. Case in point, the software program that is used by a lot of small businesses is called QuickBooks. So there again we see this book idea. Now, for those people who then try to manipulate or falsify or put together fraudulent books, doing accounting in a way that is not supposed to be done, that is what is called cooking the books. So here's a news article, hospitals under pressure to cook the books. Here's a title to an article, also top 8 ways companies cook the books. So if you hear the phrase cooking the books, they're really talking about messing with or manipulating the financial information so as to mislead people, okay, to think you're better off than you really are. And that's what we call fraud. We'll get into that later. Now, double entry accounting in particular. This is the invention of the Italian merchants. Double entry accounting is where you record what you are given, what you give in the situation, and what you receive. So, we're going to take a look at how that actually works in this video. The 2 books that matter the most, the General Journal and the General Ledger. 2 separate kinds of books, but they are linked together. So the General Journal records daily business transactions. So a journal, like a diary, is somewhere you record what happens during the day. And so the General Journal is where we record the transactions a business enters into on a daily basis or throughout the day. The General Ledger shows the effect of those daily transactions on each of the elements of the accounting equation. And so the General Journal transactions have to then be posted, or another way you can think of that is we have to move the transactions or copy them from the General Journal over into the General Ledger so that we can figure out where all the elements stand at the end of the day or at the end of the month. So one of the ways you do double entry accounting, so we're going to take a look at what double entry means here. Let's say we're going to use our fake company here, Carl's Canoes, and that Carl, the owner of the business, invests $10,000 in cash into the business. And so assets in our equation, cash is one of those assets. Cash goes up by 10,000. But if that's the only thing that happens, that we record what the business received, $10,000, we have a problem with this equation, right? If our assets go up by 10,000, then the equation is not going to balance. And so we have to record not only what we receive in a transaction, but what we give. So in this situation, the business, Carl's Canoes, received $10,000 cash, but it also gave Carl shares of ownership in the corporation. And those shares of ownership are what we call common stock. Now, common stock, it is an account or element that represents the amount the owner has invested in the business. And so common stock goes up by 10,000, cash goes up by 10,000. Our equation is still in balance. Now let's say that we go to the bank. We borrow some money from the bank. What's going to happen? Well, our cash is going to go up. So the business's cash, its asset, cash, goes up by 5,000. But if that's all I do, then again you see I have an unbalanced equation. My equation does not equal. And so we have to record not only what we receive, which was the money from the bank, but also what we gave the bank. And what we gave the bank was a promise to pay the bank back. And so we have a liability. Liabilities, again, by definition, are amounts that the company owes other people. And so we have a note payable. We've signed a promissory note with the bank that we will pay this money back in a certain amount of time with a certain interest rate. So $5,000 cash goes up, liabilities go up by 5,000. Our equation still balances. Now let's say that we take some of this money, $2,000 worth, and we buy some equipment. What happens here? Well, our cash goes down by 2,000, but we've received equipment that has a cost, historical, original cost, of $2,000. So what overall happened to my assets here? Well, nothing, really. They went down by 2,000 and up by 2,000. And so my equation still should be in balance. Now, I can say, well, let's say I take some money, cash, $100, and I buy some supplies. Well, again, what happens to my equation here? Nothing. Overall, right? My cash goes down, my supplies go up, so my assets in total haven't changed. So in each of these situations, I am recording both what I gave and what I received. That is what double entry accounting is all about. Now, at the end of the day, what do we want to make sure is true? We need to make sure that the equation is balanced. And so in this case, we have $12,900 in cash after all the things we've done, $2,000 of equipment, and $100 of supplies. Overall, on the liability side, I have $5,000 that I owe other people, and $10,000 that was invested by the owner. And so, on the right side of my equation, I have $15,000, and on the left side of my equation, I have also $15,000, which means my equation balances, as it has to. Now, this is not a very practical way to do things. There's no way to easily check my work for accuracy midway through or partway through. I have to add up all the transactions to figure out if I'm still in balance. And so for the few transactions we have here, it's not a big deal. But if we have a company that has thousands or hundreds of transactions a day, that would be very more complicated, right? It'd be a whole lot more difficult to do. So the Italians came up with a way to do this to make sure that the equation stays in balance at all times. So we need a way to ensure the equation stays in balance at all times. Each element of our equation goes up and it also goes down. So we need a way to keep track of these increases and decreases in such a way that it will ensure that the equation is balanced every single time we do a transaction. And so the medieval Italian merchants came up with a system, and they used what are called debits and credits. And so each account, represented here with T's, we call these T accounts, obviously because they look like T's, has a left side and a right side. The left side is called the debit side, and the right side is called the credit side. Now, the right side and the left side, the debit, credit, are the same for every element, the same for every account. But which side shows the increase in that account and which side shows the decrease in the account or element differs. So for assets are going to be debited to show increases, and they are going to be credited to show decreases. Liabilities are going to be credited to show increases and debited to show decreases. Stockholders' equity will be credited to show increases and debited to show decreases. So at least with this very basic equation we have here, you can see that assets on the left side of the equation are increased on the left side of the account. And liabilities and equity on the right side of the equation are increased on the right side of the account. So liabilities and equity are credit accounts, and assets are debit accounts. And as long as debits equal credits, the equation stays in balance. Because as long as the credit balance accounts add up to the debit balance accounts, we know that the equation is balanced. So let's see how this works a little bit. Before we do that, most of you are going to have one of these. This is a debit card. Why are debit cards called debit cards? Many of you use these. Many of you have checking accounts that come with these. Your money deposited at the bank is a liability for the bank. It's not the bank's money. It's money the bank owes you. Your use of a debit card reduces the amount of money the bank owes you. So, since we see here that liabilities are decreased with debits, and the bank owes you money when you put money in the bank, your bank account, your checking account, is a liability for the bank. And when you go out and you use your debit card, it reduces the amount of money that they owe you. So a debit decreases a liability, and you have a piece of the language of business in your pocket or purse right now, and that is what makes accounting awesome. All right, moving forward. So, how does double entry accounting actually work? The first thing you have to do is record business transactions in a journal. Now, to do that, there are a few steps. First, we have to determine the elements or the accounts that are affected by the transaction. Then, we have to determine whether the transaction leads to an increase or a decrease in each of the elements. Are they going up or are they going down because of what the business does? Third, we have to determine whether that increase or decrease requires a debit or a credit to each element. Again, some elements are increased with the debit and some are decreased with the debit. Some are increased with a credit and some are decreased with a credit. So we have to understand what to do. And then lastly, we have to record the transaction in the journal. Now, when we put entries into a journal, we typically refer to these as journal entries. So we're going to try this out a bit. Okay. Here we have a very basic journal. It has a column for the date, a column for the accounts, or elements as we're calling them. Really, we mostly refer to them as accounts, but technically they are called elements. The debit and the credit columns. And so we have to answer these three questions. What elements are affected? Did they go up or down? And does the increase or decrease mean that we need to debit or credit? So I have some transactions here, not very many, but we're going to go through and we're going to journalize these. So letter A, we borrow $500 from the local bank, signing a 6-month promissory note. We're going to pay the money back. What do we do? What accounts are affected? If we borrow money from the bank, we are going to receive cash. So cash is affected. And we owe that money to the bank. So we have a liability, money we owe other people. And in this case, in particular, we signed a note. So we have a note payable. Now, cash goes up. That's pretty clear. The amount we owe other people also goes up. And so we have two things that are increasing here. Well, what does that mean for our journal entry here? For journal entry A, okay, we don't really have dates here. We just have some letters, but that's okay. What accounts are affected? Well, cash and notes payable. What happened to cash? Cash went up. How do you show an increase in an asset? Well, that's with the debit. So I am going to put in the account cash, and I'm going to debit it for $500. Now, I also have a note payable, a liability. I owe money to other people, and the amount I owe other people is going up. It's an increase. How do I show an increase in a liability? Well, I know my debit card decreases my liability that the bank has for my checking account. So liabilities are increased with a credit. And so I'm going to credit notes payable for $500. And that is my journal entry. Now, what do we notice here about the debits and the credits in this transaction? The debit and the credit both equal $500. So, as long as debits and credits are equal in my journal entry, I know my equation is going to balance. So we'll see how that works. So let's go back to our presentation. This is what it looks like. So my general journal, cash, notes payable, $500. And then what I have to do is I have to post that journal entry to my general ledger. I have to update the elements with these new numbers. So my cash account here, this T account, I'm going to debit it for $500. Debit side, again, is the left side. Credit side is the right side. The notes payable account, I am going to credit for $500. The second transaction, transaction B here, paid $300 for canoeing equipment. So if Carl's going to run a canoeing business, he's going to need some canoes and some paddles and stuff. So he spent $300 on canoeing equipment. Well, what accounts are affected by this? Well, the cash is going to go down by $300, and I'm going to get equipment in exchange. So how do I record this? Well, an increase in equipment, which is an asset. We show it increases in assets with a debit. So I'm going to debit equipment for $300. My cash goes down here, and I have an asset when I have cash, and assets are decreased with a credit. So I'm going to credit cash here for $300. And again, my journal entry debits and credits equal $300. Now what you notice in these two journal entries, first of all, debits always come first, as you can see, and then credits come second. And the second thing that you notice, likely, is that credits are indented in the journal. This just really makes it much easier to read the journal if we have a systematic way of distinguishing between debits and credits with the names of the accounts in addition to the numbers. So we go back to our presentation here, and what happens? Well, cash had a $500 debit, now it has a $300 credit, and the equipment account also has a $300 debit. We're just simply taking the debits and credits from the journal, moving them over into the appropriate T accounts. Now, transaction C. Received $1,000 from Carl, the owner, in exchange for shares of ownership. So if Carl invests $1,000 of his own money into this business, right, the business's cash goes up. So if we have an increase in an asset like cash, we debit cash $1,000. What did we give here? Well, we gave Carl shares of ownership in the business, and we call those shares of ownership stock. And so his investment in this business has increased as a result of this. And so we are going to increase the equity account for common stock. Now, equity, like liabilities, is increased with a credit. So we're going to credit common stock. Again, our debits and credits equal $1,000 each, so our equations should still be balanced. We go back to our presentation. Here we see the cash goes up here, debit of $1,000, and then the common stock is credit of $1,000. Last transaction, transaction D, we bought $150 of supplies on account, which means we have not paid for them yet. We purchased them, ordered them, they sent the supplies to us, and they also sent us a bill that says we owe $150 for these supplies. So no cash has been sent yet. So what accounts are affected? Well, supplies is going to be affected, which is an asset account, and it's going to go up. The amount we owe other people is also affected by this, so our liabilities are increasing. So which liability? Well, it's not a note payable because we didn't borrow money from the bank. Here we have what is called an account payable. It's money you owe for goods or services. So supplies, our asset account, is increasing. We show increases in assets with debits. And the amount we owe other people in the form of accounts payable, a liability, is also going up. And we show increases in liabilities with credits. So A, B, C, and D here, these four journal entries, right? Debits equal credits. So, after recording the entries in the journal, we post them into the ledger, the T accounts for the different elements. And then at the end, we have a general ledger that has updated accounts or elements for the business with how much money has either been invested in an asset, is on hand in cash, or is owed to other people. Now we take these accounts, these elements from the general ledger, and we can build the financial statements for a business. In this case, we can only build the balance sheet because as far as we are in this process, we don't have any revenues or expenses yet to build an income statement with, or a retained earnings statement. We have simply been purchasing assets and acquiring capital, and that really only affects our balance sheet. But we have something new here added to the balance sheet that we didn't have before. Current assets. Those assets that the company expects to use up or turn into cash within 1 year. So before, we didn't have a distinction between current and long-term assets, but now we do. We're going to make that distinction because it's important for something we're going to do in a minute. The second new classification are current liabilities, and these are liabilities that the company must pay off within 1 year. And those then are going to require current assets to do that with. So we have, in this case, with Carl's Canoes, $1,350 of current assets. And with those current assets, we're going to have to pay off $650 of current liabilities. So does it appear that we're going to be able to do that? Sure. But one of the ways we analyze this is called the current ratio. We take the total current assets and we divide it by the current liabilities. So in this case, we take the $1,350 divided by the $650, and that gives us 2.08, which basically means that for every dollar that it must pay off within the next year, the company has $2.08 into current assets with which it can pay off those current liabilities. So making these distinctions between current and long-term assets and liabilities is very important for us to be able to determine the solvency of the business over the next fiscal period or year. So, to sum up what we talked about in this video, the system we use has Italian foundations. The 14th century Italian system of bookkeeping serves as the foundation for accounting as we know it today. There are two types of books that existed, and they still exist, just in different form. Journals are used to record business transactions. Sometimes they are called the record of original entry. Ledgers are used to summarize the effects of transactions on the elements of a company's accounting equation. What is double entry accounting? Companies record both what is given and what is received in every transaction. As a result, every transaction, every journal entry, affects at least, at minimum, 2 elements or accounts. How are books kept today? Today, the books are kept electronically through software programs. Some companies develop their own homegrown accounting systems, and others purchase an accounting information system from a third party, like the QuickBooks example we looked at before. To understand what software programs are doing, though, we have to first learn how accounting is supposed to work on paper. If we understand how it's supposed to work on paper, we can then transfer that knowledge into the technologies that exist, that are out there. So this course is really about understanding the paper-based system. How is accounting supposed to work? And then we can think about how it might work or be done a little bit differently in an electronic world. And remember,